This is actually a good one to talk about, because assuming that the Roth is always best when it comes to making contributions. That's not true all the time.
That is not always the case, and it's usually determined based on current tax bracket and where you maybe or will be in retirement.
Right.
Sometimes that's not easily defined, and so if you're in your lower tax brackets, Roth is probably better. The middle tax brackets, maybe uncertain, and the higher tax brackets, if you know it's going to be lower in retirement, then traditional or pre-tax contributions.
Right.
So one way to go around that, if you're in the middle and not sure if you're going to be in the lower or middle brackets in retirement, you can split those contributions.
Right. Split them up.
Yeah.
Right.
Do a little bit of each and
Sure.
give you some flexibility down the road.
Right. All right. And if you're in the higher tier, like you said, I mean, well, it really comes down to where are you going to be when you do retire, right? Because we have that earned income coming in, or W-2 income. It may make sense, like you said, to do more contributions to the traditional, get that tax deduction, convert later. I mean, I don't know people's tax situation. I mean that's the whole point of this show is to do a blanket across the board. But I also want to talk about a backdoor Roth. I mean, there is a pro rata. I mean, I want to address this one because this is something that's also that people may utilize.
So for those who have heard of the backdoor Roth, to be able to make contributions directly to a Roth, you have to be income eligible. There's a range of incomes where your amount of Roth contributions are capped out. And so if you're looking at a backdoor Roth, same income levels apply to the deductibility of pre-tax IRAs. But a backdoor Roth is making a non-deductible contribution to an IRA.
A non-deductible
Non-deductible because your income is too high.
Yep.
And then converting it to a Roth.
Then converting.
So one thing to be aware
of. There's some caveats though.
One thing to be aware of.
Yeah.
There is a pro rata rule.
That's right.
So if you have employer-sponsored plans out there, 401ks, 403bs, does not apply. But if you do have an IRA at one place, you open a second IRA to make that non-deductible contribution and then convert it, you are going to get prorated across those balances. So there may be some of that is taxable when you do a Roth conversion.
That's a great point. So again, folks, just beware of that. There's a lot of cool things that you can do. The question is, does it make sense for you? So make sure you seek a professional, specifically a tax professional. Okay, let's talk about delaying the IRA in the Roth. I mean, in terms of a planning perspective.
If you have money, you're thinking, I may not have that right now to be able to use 30 years from now. The one thing with Roth IRAs is that you can always take your contributions back out tax-free.
Right.
You didn't get a tax deduction going in, you can take those out tax-free.
Right.
It's not ideal, but you are, if there are some short-term considerations or you're looking at not having enough saved, you would be able to access the Roth contribution.
Right, it's FIFO. The first in is also the first out, right? So yeah, now the big one. This is the big one. We talked about this last episode, and it's the 5-year rule. What in the world is the 5-year rule? Because you were really hitting the nail on the head there. A lot of people say, oh yeah, I'm gonna put money into a Roth. Boom, it's tax-free from day one. Hold on, let's pump the brakes. That's not how it works. So there's actually 2 5-year rules. Let's talk about that.
The first 5-year rule is just the age of the Roth IRA. So it's counted to January 1st of the year you make your first contribution or conversion. Earlier we talked about waiting until the tax filing deadline. So you make a contribution in March for the prior year, your 5-year anniversary started at the beginning of the prior tax year.
Now you said a IRA, Roth IRA. We're not talking about the Roth 401ks, right? So the first 5-year rule is, have you started a Roth, right? And so if there's a tip for people out there, if it makes sense for them, is to do what? Start a birthday.
Just get one going. And there's
$100, doesn't matter.
There's no income, there's no dollar amount requirement.
Right.
It's just to have that Roth IRA open and, funded with a little bit of money.
It doesn't matter how much, as long as you start a birthday for the first 5-year rule. Now let's talk about this one. Let's just say that we did do a Roth conversion. Let's talk about this. If you did a Roth conversion prior to age 59 and a half, okay? So the question I would have is, okay, did you accomplish the first 5-year rule of starting a birthday? Otherwise, there's a 5-year rule there.
On each individual Roth conversion.
That you did.
On each Roth conversion that you did under 59 and a half.
Right.
So if we're sitting here looking at using these for retirement, Most people are probably looking at using them past 59 and a half. So look at starting the Roth IRA anniversary date.
Start a birthday. I mean, that's the takeaway. Start a birthday. Okay. Well, I just talked about doing a Roth conversion prior to age 59 and a half. Let's say you did this, Tommy. Let's just say you did a Roth conversion of $50,000. I'm just using a number. And of the 50,000, let's just say 10,000 of that went to taxes.
Under 59 and a half, the amount of money that does not make it to the Roth IRA is considered an early distribution. So it is the full Roth conversion amount is taxable, and then you're looking at an additional 10% tax penalty on the amount that didn't make it to the Roth.
Which would be the amount that went to the IRS, for example, for taxes.
Withheld for taxes, yep.
Right. And now, again, I mean, depending on the state of who our viewers are listening to, but here in the state of Iowa, again, if you're over 55, you wouldn't pay any tax on that for state tax.
At the state tax,
At the state tax level for Iowans that are 55 and older. So beware of that. I mean, that's something that a lot of people don't realize. They go, wait a minute, I thought, nope, you sent that money to, it's classified as a distribution. It is what it is. How about this one? Let's say you did a Roth conversion and you go, oops, I did too much. Can you reverse it?
Too much being you bumped into a new tax bracket, or
good point. Yeah.
Or you're, on Medicare and you're looking at the income related amounts.
IRMA.
You get IRMA.
Yeah.
It makes Medicare more expensive. You do too much, you can no longer do what's called a recharacterization.
Right.
So you can't say oops.
You can't say oops?
You can say oops, but you can't do much about it.
You can't do That's good. Well, it's not good. So folks, I mean, we're laughing about it, but beware of this. I mean, in the past, you could redo it, you could refix it. Can't do that anymore. I mean, so when it's irrevocable is what we're trying to say. So if you're considering a Roth conversion, I just said earlier, speak to a professional. Thanks for watching Retire Vivid. Want to see more? Like and subscribe to our channel to stay up to date with exclusive Vivid content. Plus, be sure to watch our show Retire Vivid every weekend. We're here to help you get retirement ready.